Welcome to Vetted VA Live. We are actually here on episode number 6. It seems like we just started, but as a reminder, if this is your first time here, we get together every week. We get several of the experts from the Vetted VA community, both from the real estate and the mortgage side. We're going to see tonight that we have just mortgage folks here. We didn't have any of our real estate wizards available to join us. But the topic we're going to go through really leans towards the loan side. So tonight, we're going to take a dive into home equity lines of credit, what they are, when you would want to use them, when they're appropriate, and when you might want to go a different direction. If you haven't seen any of the previous episodes, you can go back. We've got 5 others. We went through understanding the loan estimate, getting VA offers accepted in the current market, home inspection versus home appraisals, what is underwriting. So we're seeing a lot of views, a lot of people getting value in going back and going through those and seeing what the experts have had to share on that. So thanks for joining us. Want to introduce the panel tonight. Starting on the top row here with me, we've got Leroy Romero from Lotus Financial Network in Glendale, Arizona. Leroy, why don't you tell us about how you started up with Vetted VA and anything you think would be helpful here for the audience?
Thanks for having me on. An awesome panel tonight, so appreciate that. Great mentors of mine I've looked up to for a very long time. So Vetted VA was just an idea a few years ago from Chris, and I know Jason's been here forever as well. So the first moderator for Vetted VA, which is awesome. So, and then I try to follow him as much as I can. So coming in, but it was such a cool idea from just the overall prospecting piece of what our job really is to more free information and education for veterans that they don't have to go through some big funnel just to get the service that they deserve. And so that's kind of how it came about, and it was attracted. I teach all over the U.S. about VA loans, and so when Chris approached me, I was like, man, I'm all in. So it's been amazing to see the group grow and just the veterans in the group and their education and how they're constantly educating each other within the group. So it's been a real honor and a pleasure to be here.
Absolutely. We're happy to have you here. So on the bottom row, we have Elena Boland, the prettier of the two on the bottom row. And you, Elena, you are in Reno, Nevada. What is it?
Yes.
Is that the biggest little small town in the world? Is that what they call it?
Biggest little city, you got it.
Perfect. And how about yourself? How did you find your way here to Vetted VA?
Vetted VA, I found through a mortgage broker group that I had just hooked up with about a year beforehand. And I noticed a lot of people talking about Vetted VA. And then all of a sudden I got the call from Chris and I was like, it's him. I must be doing something right. Because basically, for us to get the call, it meant that you were already doing something right for veterans because for you to be asked to moderate in the group means you have to know what you're doing, number one, and number two, that you're conducting business in an ethical way, and knowing that's going to push through to how you treat all veterans in the group. So it was a big honor. I've been in the group about 2 years now, moderating, and I learn from it every day. It's helped me not just with how to moderate, but it's helped me how to treat all clients differently in the best way.
And I didn't ask Leroy or you, Elena. I already know the answer for Jason. Are either of you veterans?
We just got one. And Leroy's our veteran today.
Perfect.
And Jason's our veteran as well.
Jason is our last, but certainly not our least expert here, out of South Carolina, a mortgage broker. Why don't you tell us, as Leroy said, you were one of the first folks one of the first moderators in the Facebook group for Vetted VA. Tell us a little bit about your journey and how you got here and hooked up with Chris in the community.
Yeah, it was a mortgage conference down in, I think it was Miami or Fort Lauderdale, that we were just finishing up, and Chris Grass said, hey, I need you, and Eric Tan was there, and Robert Lynn was there, and Isabel was there. There's probably 5 or 6 more of us that I don't think stuck around. And we just sat down next to the pool around some lounge chairs and started a game plan of, hey, we can make something incredible. Let's put our heads together. And that was the very first meeting. And it just kind of blew up from there. I was the first moderator. It was completely different feel, completely different than what it is now. But like what Leroy says, the thing that I'm most proud of is seeing the vets give just as good or better answers to the other vets than some of us moderators do. And that just makes me so proud that we've been able to either attract that level of talent, in the vet community, or been able to teach them, by proxy, because none of them have gone through the class, teach them through proxy to be able to go be, ambassadors and emissaries to their peers in their workplaces and their work centers, to teach, so that way there's less misinformation out there about the VMO.
Absolutely. It's a super cool forum to have. You think back 25 years ago, there's no internet, and now there's a place where thousands of veterans can get together to ask and answer, and get the right answers to their questions. Just to put that in context, this group here, the panelists that we have tonight, helped over 800 families in the last 12 months with their financing, whether it's a purchase, whether it's a refinance. So tons of experience, tons of knowledge here. Before we jump into the topic, always want to point out and remind the primary purpose of us being here live every week is to answer your questions. So we're going to go through the topic at hand and get everyone's ideas and thoughts on it, hopefully give you some education that's helpful there. But if you have a question regarding home equity lines of credit, VA loans, anything housing or real estate or mortgage related, throw your questions over there in the comments and we will answer them as we go. So with that in mind, Leroy, did we say we nominated Elena to start off with educating us on what a home equity line of credit is?
Yep.
All right, Elena, that's you. You got to tell us exactly what they are and how they work.
No problem. I feel like anytime we're speaking mortgage and real estate, there's always a lot of acronyms. So I just want to start with the basics of what does HELOC stand for, because it's an acronym, and it just stands for Home Equity Line of Credit. So when we say HELOC over and over again, just think line of credit attached to your home equity line of credit. And it's really essentially used like a credit card with a lien against your home. So I tell everyone, take it very seriously, because even though you're literally given a card and checks to write against, you're drawing from that equity. And if you skip a payment, it's very serious and you have to take it that way. So you want to watch closely, make sure that you put it on auto pay, and make sure that no 30-day lates or any lates really, of course, if they're avoidable, are added onto that mortgage account that you're drawing on. There's a lot of different variables that are added into the HELOC, the home equity line of credit, that decide how much you can borrow on. They are typically in second place to your first mortgage. I know for our target audience here today, typically you're going to have a really great rate right now on your VA home loan. So that means a home equity line of credit might make more sense than completing a cash out refinance and losing that great rate that you've got right now. So it's just become a more popular product in recent months as we're in that raising that interest rate going up across the board for all loan products right now. So certainly because they're in second place, they do tend to have higher rates, but because it's a smaller portion of your mortgage, it does typically make sense for a lot of people.
So how is the rate determined on a home equity line of credit? People hear this, okay, cool, it's a line of credit. They say I have a credit card and I kind of know how my interest rate works on my credit card. But Leroy, if you go and get a home equity line of credit, how does the interest rate work and what do they look like in the current market?
Well, the first thing here, everything's going to be tied to credit score, right? So that's where a lot of the determination is going to be. And every single investor is going to have different either loan to value limits. I know Jason and I were just talking in this chat before we started. I mean, there's some out there that can go 97% loan to value. So as a CLT, combined loan to value, and that's going to be equity position in your property. But most of this is going to be very, very credit driven. And we're going to see that either tighten up as we go further into the conversation about what we're going to talk about today. And so that, I mean, it's really that easy, that simple. Obviously, making sure your payments on time, a little bit higher credit scores on certain investors, some forgiveness a little bit on the other investors, but a lot of it's going to be based off of loan to value.
Jason, why don't you go a little into depth? So we're coming off of a funny market. People haven't used home equity line of credit, especially in the VA space, nearly as much as if you go back 15, 20 years when they were really popular. Why did they fall out of favor? And how has that changed for veterans over the years? What is unique about the VA loan that maybe made HELOCs a little less attractive to veterans, but has changed here recently to make them so popular?
Sure, it's all about cost, right? It's like Lee was talking about was the interest rate. Interest rate is generally adjustable on a home equity line of credit. It's not going to be fixed, so that tends to scare a few people. And the market that we were just in was just spectacular. We were locking rates, in the low twos for a long period of time. So there was no desire to go get an adjustable rate that's going to be significantly higher than a 2 point something or a 3 point something. So HELOCs fell out of favor. I mean, I probably couldn't spell HELOC for a year because I just forgot about them because they just weren't, there just wasn't any desire for them. But with the rising interest rate market that we have, we've gone up, full 2% across the board on nearly every loan out there in the last, 90 to 180 days. HELOCs are becoming much more attractive now. The average good rate right now for a VA loan is probably upper fours, maybe lower fives. It's a little bit challenge score. HELOCs are generally priced relative to the prime interest rate. And the prime interest rate is something that the banks set to charge a baseline interest rate to consumers. And it doesn't change very often. If you go back the last 7 years, prime interest rate has gone over from 3 to 5.25 down to 4.25. It's fluctuated in the 3 to 5 range for the last 7 years. Well, your interest rate is going to be prime plus some factor. And that factor or premium is going to be dependent, like what Leroy said, was the combined loan to value and the credit score. This week I quoted somebody a rate of 4.99 on a HELOC, and I quoted someone a rate of 10.25 on a HELOC. So it just depends on what your interest rate is and how much equity you want to consume with that second lien that Elena was discussing, the lien position.
And one of the things that's unique about the VA loan program, almost every other loan program, if you want to take cash out, you're limited to 80%. With VA, we can go 90 with the best terms, and many lenders will go to 100%. The program itself goes to 100%, and that's one of the reasons why HELOCs weren't super attractive in the VA space. If you had a conventional loan and you were somewhere at 75, 80%, there wasn't a whole big reason to do cash out. You had to go to some type of second mortgage product to get that higher loan to value. With VA, we don't have that limitation. So the interest rate change and the interest rates being much higher is kind of what's moved things in that direction. Does one of you kind of want to go into the concept of a blended rate and looking at that, of seeing when it makes sense in terms of, we may have a veteran that has a little tiny first mortgage. They've owned their home for 20 years. They owe $100,000. They want another $100,000. How does that vary from the veteran that bought last year, has a $400,000 first mortgage and needs $30,000 to do some work around the house?
I'll just chime in, Josh. I think that's, and then everybody else chime in too, it's a really good question. When you look at your own specific scenario, I think the best approach to anything in finance, when we talk about home loans, VA loans, conventional loans, FHA, if you're moving around or doing stuff like that, or maybe you've maxed out your entitlement, but the path is always math. So what is going to make the most sense on paper in total interest paid, and then also time in the home, right? So we know that National Association of Realtors said a consumer is going to be in their property for a minimum of 9 years, which is actually up quite a bit. And given the the last couple of years circumstance with COVID, things like that have come up, we're not seeing as much migration, but now we're seeing a huge migration into certain different states. So I think it really comes down, if I was talking to a client on there, is does this really make sense to go more of a home equity position, or does it make sense if you say you have a $100,000 loan and you want a $200,000 home equity line or $100,000 home equity line, so a total of $200,000. Could it make sense to do a cash out refinance? Well, we got to look at the math and we got to back our way into it. Like, what's the plan on getting that paid off and what's your goal? Could you maybe possibly go a shorter term and then just hammer that principal? So that's one approach too to look at. I really like that question, because as veterans ourselves, I think when we look at the home equity line piece, since we could go 100%, that changed a little bit in 2019 when they became what's called LLPAs, loan level pricing adjustments, once we went over 90%. And there's a factor on why that happened. With Jenny Mae pools, and I can kind of go off on that, but we were kind of limited back to that 90% for the best pricing. And so you got to take that in consideration. Are you a disabled veteran? Are you exempt from the funding fee? Does it make sense to do a cash out refinance and pay the subsequent use side of it? So there's a lot of different factors when considering a home equity line. And sometimes a home equity line could just be a better option, depending on how long you're going to be in the home.
we talked about math and we talked about being strategic. Why don't I don't think most veterans stay up to date like we do on the mortgage side in terms of what those funding fees look like. Unfortunately, we're seeing more and more veterans with disability ratings, so they're exempt, so that doesn't come into play. But if you're not exempt, it can make the cash out not look good at all. So does one of you want to kind of go through the concept? Jason, I see you there. What are your thoughts about how the funding fee, we know the program's awesome. We can go to 90 or 100% cash out, but how does that funding fee enter into the equation and make HELOCs in the current market even more attractive?
Sure. I was going to say, that's good. I've got one other thing to cover after that as a factor that is kind of a surprise to me that we developed over the last couple of months. But yeah, the funding fee of 3.6%. Let's say you're doing a cash out refi and you're pulling out 80 grand, you owe 420, so your new loan amount's $500,000. Well, if you don't have a disability rating, your funding fee is going to be what, $17,000-$18,000, somewhere in that ballpark, which is not fun to get $70,000. I mean, that's, let's call that 18%, of your equity that you're pulling out it's going to cost you 17% of that just to cover the funding fee. So that just doesn't make any sense whatsoever. At that point, it may be worthwhile considering conventional, but it also may be worthwhile to talk about the HELOC. Now, one thing that we talked about in the office recently, and I've been teaching my junior LOs of when to shy away from a HELOC, is understanding that person. It may look good on paper. Oh yeah, we're gonna raise we're not raising interest rate on the first loan. Yeah, we're getting a higher rate on the second. But how sensitive is that client to cash flow, the monthly cash flow? What are their bills like? Because you go get a HELOC that we're not changing the 2.5% or 3.5% interest rate on the first mortgage, but now we're getting a mortgage at the 6.5%, 7.5% for the second. But if you got a 20-year amortization, the amount of monthly payment might be $300 a month more, $400 a month more than doing a cash out on the first and get the same effect. So you got to understand that beyond just debt to income ratio, beyond just residual income, you've got to understand what that client's going to do with that money. Are we paying stuff off? Is he going to have room? He or she going to have room? And what's their other stuff? Is there child support? Is there bills that that we don't typically cover in a mortgage application? What position you put them in a monthly payment if you go at a HELOC on a 10 or 20-year amortization?
And again, it goes back to being strategic and to working with an advisor. Like if you do, when we talked about one of the sources for getting these loans, banks are really good at them. They look at them like credit cards. They're sort of loss leaders, so they can give good terms. But if you go to the person in the branch that does HELOCs, they're going to tell you, hey, HELOC's wonderful, let's do it. Versus talking to a lender that can do a first, can do a VA first, can do a conventional first, can do a HELOC. You can kind of look and pencil all those things out and see how they look to the client, not just to today, but also over time. Leroy, do you want to kind of talk about a really important thing that you brought up earlier, is that when we talk about a rate being 4.75 or 5.25 today, much less the one that Jason quoted at 10% to another borrower, what do the coming Fed actions have to do with HELOCs, and how do they make them more or less attractive over time, and kind of how does that impact where we are currently? So any of you guys, I think this is kind of a good part of the discussion, saying, Jason, you brought it up. Like I ran the numbers in the Optimal Blue Mortgage Market Index. It's a good industry-wide number. I wouldn't rely on it, but it shows you the sort of the scope of the magnitude of the movement. From December 27th, the average VA loan in OBMMI was 2.97, and yesterday was 5.235. So a full 2.25% move in a little over 4 months. So people sometimes get confused with what Fed actions do and what market actions do, and how that's going to impact VA rates going forward and HELOCs. So any of you guys jump in and kind of tell us what you think is the likely trajectory over the next year or two of interest rates, and how that impacts the calculus for using a HELOC versus a cash out refinance.
The HELOC is definitely going. I mean, just in the last 30 days, the prime rate that I was talking about earlier has gone up by a full percent. Right? It was 3%, 30, 60 days ago. Now it's 4% today. As of I think Friday last week, it went up another 0.5%, which is not lockstep with the Fed's rate, because the Fed's the overnight funds rate. You have the other rate is set by the banks, not by the Fed. Fed is a bank that's totally different. So we're going to have that effect, that deleterious effect. And then as the Fed continues to roll off, we'll see the mortgage, the mortgage-backed security pricing worsen and see rates go up until we end up hitting recession sometime, 12, 18, 24 months from now.
Yeah, I think exactly what Jason said. Like, nobody has a crystal ball, right? So the only thing we do as mortgage advisors is to really pay attention to what the Fed is doing. There's certain groups that we're a part of that we subscribe to that educate us on what does the baseline say, what does the trend say. Jason said, "Hey, is a recession happening?" Yeah, I mean, at some point we're going to run into that, but that's not a bad thing when it comes to the mortgage market. Historically, we've seen rates slide into that. So here's what happens, Josh, is we print a bunch of money and then we don't have enough goods, and then it goes back and forth, and we just do this all day long throughout history of the U.S., where we see, it's only a matter of time when we hit that recession timeframe. So the challenge when we have these Fed rate hikes, right, it's going to be 0.5%, then another 0.5%, all the way up to probably October. So the Fed's raising those rates so fast, and it's like a knee-jerk reaction rather than cooling into the market. And so we're on those home equity line pieces. If they're a variable line, then expect your payment to go up because it's tied to that bank-to-bank lending or that Fed rate, right? It's the variable plus. So prime plus whatever your agreement is, depending on the credit situation. So. But I think what that's going to do is springshot us forward and say, hey, look, as rates cool down, maybe in the end of the year, you got to look long term. Do you want to hang on to that home equity line, or does cash out refinance make sense in the future, depending on your life situations? Here's what I can say. I don't know. I know, Josh, you said Nate's cool with debate, and I love debate too. So I think the one thing is that if you're grabbing a home equity line to pay off a bunch of credit card debt, that's not a bad idea. But the challenge you got to look at is, how did you get into the credit card debt? That's where it is. So you can't just band-aid it with a home equity line. You got to change what's going on. And so within the budget. And so how are you managing your money in that timeline? And so will you have enough equity position in the future to be able to springboard yourself forward financially in something like a fixed rate payment where you can hammer the principal on it, or a shorter term with a cash out refinance? I think that's what I would say to the audience, is to really, hey, it's okay if you have credit card. Stuff happens, right? Good thing Brandy's not on here. I almost slipped. So, but my point is make sure that if you came across some type of medical challenge, some family challenge, some economic challenge with employment, and you're sitting on hundreds of thousands of dollars of equity in your home, there's no reason to struggle through that pain or those mistakes that you made when there's a solution out there. You just got to really reflect and say, how did I get to this situation? And if it's just spending and having a good time all the time, you might want to course correct on that going into the future, and especially when you look at a home equity line, because those payments can be variable. So just a little conversation starter, I should say.
No,
I flat out pull out my dad voice whenever I get somebody call me to do a cash out refi and everything's maxed out, and I'm like, hey, well, what do you got in checking and savings? They're like, about $1,000. I'm like, I am not moving forward in your loan until you show me a budget. It has nothing to do with the mortgage, but you're going to give me a budget of how you're not going to call me back in a year and a half with the same situation.
Jason, we had a client a couple of years ago that in 5 years he did 4 refinances, and the first 3 were all cash out. When he came back for the last one, this client made $325,000 a year, and he didn't have a huge mortgage. It's like a $500,000 mortgage, so it was big, but not gigantic for the amount of money he made. And we just went through it, and I said, here's the deal. You just burn whatever money you have available. We're going to put you into a 15-year loan, whether you like it or not. You qualify for it, but you can't just keep stretching back out to 30, back out to 30, back out to 30. So we actually got a comment here. And remember, if you guys are out here watching and you have any questions, throw the questions, and we love the comments also. But the question is, you have to consider how quickly you can pay down or off or manage the new debt. Why don't we talk about that a little bit? You guys have already hinted at it, that when a consumer comes to a loan officer and says, hey, we would like to take cash out, and you guys said debt consolidation. We have a lot of that. We have home improvements. We have other investments. But how do you guys handle the conversation of what are we going to do? This would primarily relate, I believe, to the debt payoff. If someone's coming to you to pay off debts, how do you handle that conversation? Elena, if someone comes in and they've got a $200,000 loan, home's gone up to $400,000, hey, we got $75,000 of credit cards. What does that discussion look like that you have with your borrowers?
You have to get nosy in strategy because you care as an advisor. It's just like Jason and Leroy have both touched on, just to bring it in together. For me, it's always, I'm very nosy. What are you going to do with the money? And then we look at the payments for the debts that they're going to pay off to either help increase cash flow or look at the strategy for the money. I do have several clients that use home equity line of credits as a strategy to help draw equity and go purchase investment properties. And you just have to know and check yourself on the discipline as the borrower of that money. Another thing to know, and I think it's super important and point out, is that a home equity line of credit has interest-only minimum payments. So if you have a $300 minimum payment on your Heloc and you only make that payment, you are never going to touch the interest on it. So that is huge when we're talking about budget, like Leroy brought up. If somebody is going to, use money as a strategy, if you're getting some positive cash flow from a rental property, use it first to pay off that home equity line of credit so that you can get it to zero and go do it again. So I have many, many clients that do that. I think our most common client is people just looking to pay off debt because they've made a mistake. And I tell every client, no one here walks on water. I think all of us have been through something in life, unless you're 18 years old. And if so, like, God bless you if you're 18 and you're getting a home equity line of credit, because you're much smarter than I was. But it's just something to, again, look at every client's life situation. Literally, how old are you? And it's not to discriminate against them. It's to say, what are your retirement plans? Where do you want to be in 10 years? How long are you going to be in this house? What are the closing costs going to be? How long will it take you to recoup those? It's just like, again, like Leroy said, it's just all math. We want to help them piece it all together like a little puzzle and make sure that we're not just spewing interest rates at people. We really want to help give you a strategy. This is what scenario A looks like, scenario B, and scenario C. And this is how fast each of those can get you to your goal and your finish line. I think all that is so important to go over for each and every client, which is why the human part of lending is so important in every person's life.
Absolutely. And in the context of kind of this question and what you just answered, managing the new debt, paying it off, paying it down, when we explained what a home equity line of credit is, we didn't really go all that deep onto the concept of a draw period and a repayment period and how that impacts it. You want to kind of explain that to the viewers, what it is and how that should be impacting their decision making?
Absolutely. It's really important to know that there's usually an initial draw period, and it's usually very fair and realistic. You get typically a 10-year draw period, and then at the end of the 10 years, it stops giving you the ability to draw money on it. And then you've got 20 years to repay that portion that is now fixed. So what happens is during that first 10-year period, you can pay it off and reuse it, and pay it off and reuse it, just like we described with the credit card similarities, except that, of course, it's tied to your home. So that is, again, a great strategy for some people to use that, maybe they know that they've got some great discipline going on. They can use it to buy a refrigerator and some new appliances for the kitchen, pay it off, and then move on to the bathroom, etc. So that is really nice to have if, again, that you are a conservative enough person to budget properly for that. And I love that feature. It's great to have the option.
Perfect. We've got a couple questions over here, and the first question is a doozy because we got about 4 questions in here. So why don't we just go around the horn, or any of you guys jump in. What does the process look like? Does it have the same requirements as applying for a standard first mortgage? How long does the process take, and how soon can I expect my funds? And we had talked before we came on here, for the most part, we have sources for this. A lot of people will go directly to banks or credit unions, so we're not as involved as we are with the first mortgages that we do directly. But why don't you guys jump in and kind of go through what a consumer can expect if they're looking at taking out a HELOC?
Sure. Like the underwriting is very similar. Most investors will follow the Fannie Mae, Freddie, or Ginnie Mae income guidelines as far as self-employed. You're gonna have to income qualify and credit qualify. You usually don't need to provide asset statements. The underwriting in today's market is taking significantly longer because there's a big rush on HELOCs. So like right now, the investor that I'm using, the initial underwrite is 11 days. They're looking to hire some of the underwriters that are getting laid off in the first mortgage space to adapt into the Heloc, the second mortgage, the second lien space, because of that. So it's the underwriting's taking a little bit longer. Appraisals are usually drive-by unless you're getting a really, really large amount of credit. Generally, if you're under $250,000 for that line, you're only going to need a drive-by. Your closing costs are going to be significantly cheaper. You're only going to, you're not going to have to escrow. You're not going to have all your normal prepaids. Still going to have, title charges, and if you're an attorney state, an attorney will have to close it. But your closing costs will be significantly cheaper on that as well.
That's interesting you would say that. We're here. I only lend in California. Leroy, you're in a bunch of states. Jason, you're in a bunch of states. I'd never really thought about sort of the attorney states and the way some of the different closing costs work. So for us, when the banks and the credit unions out here in California largely are advertising, hey, we'll do it at no cost. The costs are there. They're paying. They're getting themselves a title policy, but for the most part, they're eating and absorbing them. What's common in you guys' markets?
In some of the states that we're in, a little bit as far as bank wise, you're going to see that. And when you think of it, not that banks are bad or anything like that, or they might have some. I always like to call them like trigger rates, right? Because the long term play is for solicitation for the bank portfolio, right? So that's just what it is. It's always been that way. As mortgage professionals, as advisors, I think we almost. If there was a fiduciary, we don't have it on the financial side like agents do, which is phenomenal, but we've really leaned to that fiduciary responsibility as an advisor. So we've got to look at the whole thing. Like you had said earlier, Josh, is like, you hop into the bank, they just want to do it and get it done type of thing. And then for future solicitation, I think when you're working with a mortgage advisor is that you really, they take that full picture. So across the board, you're going to have the title costs, which are going to be very minimal. Obviously, the cost for credit, if you have that, and that's essentially it. There's not a ton of cost in the setting up a home equity line of credit. So usually there's not much of a fee that's on it as well through several investors that we have and that Elaine and Jason have. There's not a ton of upfront cost when you look at it. The one thing that somebody had said as far as disbursement, I don't think we answered that, but disbursement's the same way on a home equity line as it is on a cash out refinance, right? So once you close and record, then at that position, the title company releases funds and or a draw period. If you're deciding to do a draw, but all that's done at the closing aspect of it. So it's usually pretty quick, just to answer that. So hopefully I answered a little bit.
One thing I would add to the draw is there's going to be a time and period where you're not going to be able to draw on that line whenever they're trying to place it with, maybe when they're trying to place it with an investor. So you could maybe draw day 1, day 2, day 3, you'll get your initial draw, and you may not be able to draw again for 30 days. So it's a matter of understanding that investor's requirements and then understand your client's goal with that money, like we talked about, what being that proper debt advisor, and then saying, hey, get it how much you need now, and then you're going to be sitting there on your hands for 30 days while it gets wrapped up in the investor's package.
Jason, when you said that, it made me think of something else here. You talk about a time when there's draws are not available. We'll have clients that will come and say, hey, I don't need any money. I want to put it there and use it as a safety net. So if something comes up, unexpected medical expense, opportunity to buy an antique car at a discount, whatever, they may want to have that money available. This market is definitely different than 2007, 2008. But one thing that we saw with home equity lines of credit at that time, because they were done to such high LTVs, home values were dropping, a lot of the banks came and just froze those lines. If you hadn't borrowed, there's no guarantee that you're going to be able to continue to borrow against it. So it's something to be aware of. Some numbers that I kind of wanted to throw out here and kind of take the conversation in a little bit different direction. Black Knight does a lot of data. They have access to all the data on real estate. They do some good analysis. In December, they came out and they said that homeowners' tappable equity had reached an all-time high of $9.9 trillion. So people go, cool. Well, what in the world does that mean? The average homeowner had $178,000 of tappable equity. And for a VA borrower that can go to 100%, we don't even need to do this calculation. But what they mean by that is take the home's value, 80%, which you're limited to on most cash out for conventional and FHA loans. How much equity is there there? It's $178,000. So now, you know, the thought or expectation was this might be a big year for cash out refinances, and it hasn't turned out that way because rates shot up. So we're looking at HELOCs, and we can talk a little bit about fixed rate second mortgages and when they're appropriate. But besides debt consolidation, which we've covered a lot, what are you guys seeing clients wanting to do with that $178,000 average equity they have in their homes?
I did a cash out refi myself, and I went and bought a Thai restaurant because that's what my wife wanted.
Nice.
It's very random, very odd. Not going to hear anybody else say that, but
Random and odd, but it goes to tell you that it's your equity. You've earned it. You can do anything you want with it. You want to be strategic with it, and hopefully the Thai restaurant makes a lot of money and also makes your wife happy, so she doesn't come back and blame you for buying her a Thai restaurant.
I'm seeing a little bit of shift where when it comes to the cash outside of the or home equity lines is really the consolidation. I think that, you know, the clients out there, people out there are still hungover from the COVID thing, where so many people actually did lose their jobs and or their ability, right? Or they've lost their job or one income. And so now they're a full-time parent. Everybody's kind of a full-time parent, right? But they're like now have to manage the kid that they could have sent to school. And so they're re-entering the market, and they've got all this debt from that time frame. So that's where we're seeing the majority of our cash out, whether it's home equity to clean that stuff up. But I think America is just excited to be back in the workplace and getting stuff back on track. So when you look at the equity position, that's a crazy number when you look at the financial wealth that's been built in the last 3 to 5 years in real estate. Like that is like generational changing. And so people have to understand when you have that equity position, it's okay to do things like buy Thai restaurants, right? It's okay to consolidate your debt. It's okay to possibly plan on a trip. Not something you want to do to keep expenses, but it's a time where you can really reflect and say, hey, I'm 44 years old. I've worked my entire life. Maybe I start to invest in something else and start to build more wealth as the market continues. So we're kind of seeing it all over the place on what people are doing.
Here's kind of another corollary to this question. Are there any restrictions? Sarah Acevedo asks, are there any restrictions on what you can do with the HELOC money? Are you guys aware of any lenders saying, hey, you can have the money, but you can't do this with it? Besides the illegal, illicit ventures?
Yeah.
No restrictions. It's your money at that point.
And I actually had a client, I don't know, I'm not going to say that I would advise this, and we did have a very in-depth conversation, but he did this here recently. Home had appreciated massively, doubled since he bought it. It's worth about $1.7 million now. And he took 300,000 out to buy crypto. And for those of you that follow crypto, you've probably seen that that hasn't worked out spectacularly well for him. But maybe this kind of dovetails with what you guys were talking about earlier, and how the job of a good loan advisor is to make sure you're being strategic, you're thinking things all the way through and considering what can happen. The conversation that I had with that borrower, I said, okay, you didn't just get the idea that this is the first $300,000 of crypto, right? No, and he already had about $400,000 or $500,000 in the crypto market. I said, what else do you guys have saved for retirement? They're approaching 60 years of age. He had a little over $1 million in his 401k. Wife had a little over $1 million in his 401k, and they were still going to have $700,000 in their equity in their home after taking this out. So I went through it and said, listen, you're the expert on crypto beyond me. So you have a comfort level with it. You have experience with it. If you lost all of this money, you still have a bunch of equity in your home. And if you lost all of this money, you still have your retirement covered, right? Okay, cool. So we've got all our bases covered. If you're comfortable doing this, I'm comfortable doing it. And it's important that the folks that you're working with are able to have those conversations and just kind of guide you through what you should be thinking. No one should tell you what decision to make when getting the loan, but they should guide you through and make sure you're asking yourself and answering the important questions there to getting it. Had another comment here, really. Someone just said, we cashed out before rates jumped. So they didn't, not necessarily HELOC, but they cashed out and remodeled their backyard. Luckily kept the same rate. So that was an option last year. We were talking about it earlier. A lot of folks doing cash out refinances instead of home equity lines of credit. But when you have all of that equity in your home, I mean, maybe you guys can talk to this. A lot of our clients are first-time buyers. First-time buyer generally doesn't have the luxury to go buy a perfect home. It's a nice home and it fits their needs. But now that it's appreciated $100,000, $200,000, $300,000, you can make that starter home into a much nicer home. Do you guys see many of your clients tapping their equity and doing home improvements like this?
Yes, absolutely. Just like you said, a lot of people were having to purchase homes that weren't in perfect shape in the last few years or so just to stay competitive and get what they could and get their foot in the door. And just simple things like for most families, they could not afford a roof if the roof went out. And this is a good situation to help with something like that, all the way down to a full kitchen remodel. And again, just going into the discipline with that. If they know and we counsel them on, look at this, how fast do you want to pay this off? This is how much you should divide it out by 60 payments. This is how much you should apply to that loan to get it out of your hair in the next 5 years so you can keep that great rate. Another thing that we've been seeing, multi-generational changes, just like Leroy was talking about. We've been having all of a sudden, like the last 60 days or so, a lot of clients call in that have been longtime clients calling in to want to help their younger family members get into homeownership, because a lot of them are dealing with appraisal gap contingency issues. Their younger family members are putting offers out there and they have enough for maybe a down payment or closing costs, but they don't have enough for appraisal gaps. So we are definitely seeing a lot of that with HELOC requests, so that those older generations who have maybe paid off their home can use the HELOC as a strategy to help cover those family members' appraisal gaps.
That's a good one. It's funny when you said that and started talking about multi-generational. I don't know how big this is in you guys' markets, but in Southern California, the ADU stuff is getting crazy. So an ADU is an accessory dwelling unit. Our great state of California decided that everyone, anywhere at any time on demand, should be able to put another dwelling unit on their lot. So it's opened up opportunities. And for the last few years, it was, hey, let me do a cash out refinance and I'm going to put a granny unit in the back, or I'm going to put a casita to do my work in the backyard. And we don't have that luxury for the most part right now without paying a big premium. So we're seeing a lot of that in California, people wanting to put an ADU in. They do a $100,000 HELOC. And this is probably a good place to kick off this conversation. We hinted at it. A home equity line of credit is great in that you can borrow incrementally as you need it. But the downside we talked about is the variable rate. Does one of you guys want to explain the other option of a fixed rate second, which can be a really good option if you're going to do something like put in an ADU that has a fixed cost and you know what you need to finance?
I can touch
I
on
would say
that a bit.
it's
What do you got, Elaine?
Yep. Just the fixed rate product is something that we see that is offered with a investment property, for example. So if we have clients that have investment properties, fixed loan seconds are more readily available versus HELOCs on investment properties. So that's something that we're seeing pretty frequently, and they're using those again to help fix up those investment properties or add in ADUs. And they're a good product to just explore again with looking at all the different options, because sometimes it might come at a higher rate premium because it's a fixed rate product, right, versus the variable for that particular bank, that particular lender. And still in second place, so they've got a little bit of a higher risk factor and risk layer in there. But it's a good option to look at if you know that this is a one-time use for that money.
Yeah, I would say it's more for the less or the more risk adverse, crowd out there. Like Helena, stated, the rate is higher, and the reason why the rate is higher is if you look at the risk to the lender, the profit margin they can make over that 20, 30 years is reduced in a rising rate market. Whereas with a HELOC, with the variable rate, they're protected. They can project how much they're gonna cost and how much they're gonna make off of that loan, on a quarterly basis. Whereas if it's a fixed rate, like the fixed second, there's a lot more risk, and they don't know exactly how much they're going to make. So therefore, on that balance sheet, it's not as an attractive thing for investors.
So I think we've done a pretty good job of covering what a home equity line of credit is, why they're popular now, what you can and can't do with them, which there's not a lot you can't do with it, alternatives there in terms of fixed rate seconds. Any other thoughts that you guys have on what someone considering a home equity line of credit should be thinking about? Any questions that we didn't answer, maybe that folks would like to hear before making the decision to do or not do a HELOC of their own? Leroy, you got anything?
Well, I noticed on one of the questions, because we could see, obviously you're doing a phenomenal job moderating this, is that somebody had asked, what's our thoughts on first lien position home equities? And so we had that question that came up, and I'm not very familiar with that, right? Because 80% of my clients are veterans. And so I haven't really played in that space. So I was just curious with Jason and Elena, if you've had that option where you've seen somebody come in with that home equity like purchase basically, or home equity first position.
I've only seen it once, and it's actually funny. It's a client that I have right now. I'm doing a VA cash out refi, paying it off because he sees the rising rates, and his rate is actually lower than the rate I'm going to put him in on his VA cash out right now. But he knows in a year from now his rate could be significantly higher. So we're actually doing a cash out, type 2 cash out on that on a first. Now, I don't know if he bought it with that or if he just ended up getting it and paying off the first with it. I never did ask him that. But I've only ever seen it once.
One of the things that's funny about that, Elena, go ahead. There was something I want to talk about again prior to the meltdown, but go through that and I'll come back.
Just to touch on that quickly, I have seen clients want to use the HELOC product. It's mostly buyers that have a lot of cash flow, like they have the ability to pay cash for the property, but they want that HELOC just as the option right off the bat. And a lot of them come in knowing what they want. They want that line of credit. They're savvy buyers. They've been through the mortgage process 4, 5, and 6 times, and that's what they insist on. We do still give them all the options, but it's important to know that if you're a first lien home equity line of credit, you actually get a little bit of a rate adjustment in the upward range because you're a HELOC in first position.
And what I was going to say is back before the meltdown, it kind of got popular in 2005, 2006. In Australia, one of their big banks is Macquarie Bank. Macquarie Mortgage came over here and they were pushing first position HELOCs. There was a company called Tardis that also wanted to do a first position HELOC. And their whole thought process was you stop using your checking account and you finance your home with the HELOC and you put your paycheck in there and pay it down because they actually calculate your interest on the average daily balance. So you then pay your bills with your credit card or your check book from your home equity line of credit, and over time you would actually pay it down faster. That all went away with the meltdown, and for the most part, I actually had a client a week or two ago call in, and he wanted $1 million first position home equity line of credit. And we looked around, and we couldn't find anyone that would do one that large, which those companies absolutely did. They were happy to do them at that time frame. And even the ones that would do them, we couldn't find much, if any, benefit to the first position. So it's interesting, Elena, that in your market, that some lenders at least go, hey, we're in a first position. We should give a little bit better interest rate than if we're doing it on a second. And
now, let's say one concern that I have on the first position second, only because I was just doing this loan with this guy, is he actually had the concept of paying that second off. Paying it to zero, resubordinating it behind his VA cash out. And because they were in first position, the current lender would not resubordinate to go to second. If they were second, they would stay second, but they would not intentionally go from first position on the lead to second position. One thing to throw in there for Josh about what you're talking about with that Australian thing, it sounds similar to CMG's all-in-one product. I don't know a whole lot about it. If you know Vic Malone's real good at it. But CMG has something similar to what you're talking about.
That's funny. I had forgot CMG does it. This is what happens when mortgage nerds get together and talk. I'm glad you mentioned it because I remember they had it, but I hadn't seen it in so long. I'm going to make a note. Maybe my guy will have an option there. I'll report back to you guys and see if that makes any sense. But Leroy, thank you for pointing out that I had skipped over that question. I didn't do it intentionally. I had completely forgot. We have another good question here saying, is it advisable to tap into your equity if you plan to sell your home in 2 years? Elena, you have any thoughts on that?
Yeah, I definitely do. Again, it's just about what are you going to do with the money? I think that one positive strategy, if you know you're going to sell your home in 2 years, would be if you want to think of, and again, this is totally recanting on the question itself, but maybe you take that home equity line of credit and you think about keeping that home. And you can use that home equity line of credit money as a down payment for the next property that you do end up wanting to purchase down the road. You can keep that one and retain it and rent out, and look at the option of exploring whether or not a renter would cover the payment on that HELOC and the possible first that you have on the house.
Yeah, I mean, and all plans change. Like I'm one of my favorite sayings is man makes plans and God laughs at those plans. So yeah, I'm going to sell the house in 2 years. What if COVID hits again? You got COVID 2023, COVID 2025 hits. Nobody's selling houses for 6 months or whatever. You never know.
It's funny. I do a live every Wednesday with one of my realtors, and a question people always ask: with prices as high as there, should I sell? And our question is, sell and do what? So Elena, like what you said, okay, borrow it and do what? Borrow it and go take an extended vacation? Probably not. Borrow it and go to Vegas? Probably not. But if you're looking at fixing up the property, building some additional equity, selling it for more at the end of the 2 years, it really would come down to what you plan on doing with the money. It could be a great idea. It could be a bad idea. You could spend your equity before you get to sell the house in a couple of years.
Right, all about your discipline.
Discipline and strategy, having a plan. It's interesting that I think at different points of the conversation, you all have answered the question with basically, what's the strategy? Where are we going? Begin with the end in mind and say, these are all tools. A VA loan, a conventional loan, a HELOC, a fixed rate second, they're all just tools. And we should be using that tool strategically to get where you want to go. And experts like the three of you are helping consumers every day to make those decisions. So if we don't have any other questions here that pop up, we can sort of close it out. And again, any final thoughts that any of you guys have or that you wanted to go through on this topic, or just anything in general that anyone watching here, any of the vetted VA members should know about the financing process.
I just think that, I mean,
two things.
Go ahead.
Sorry.
Go ahead.
I'll be fast. 2 things to touch on. Just number one, to know the appraisal process is a little bit different for a home equity line of credit, and it does certainly vary from bank to bank. A lot of them will do what's called a drive-by appraisal, where they literally just drive by your home and make sure that it exists and pull county records versus going in and and going through with a physical inspection. Or sometimes they will accept the original appraisal on your home if it's been 6 months or less. So definitely ask that question if you're looking around for HELOC products. The second thing to know is make sure that your loan officer and your lender knows what they're doing. There are overlays, even though a lot of the product guidelines are similar to Fannie Mae and Freddie Mac. For example, and again, talking conventional lending typically, for Fannie Mae and Freddie Mac, if you're self-employed, sometimes if you've been self-employed for 5 years or more, we can get through the loan process with 1 year of tax returns, but on a home equity line of credit, they will not allow that. They want 2 years. So it's really important to talk through your whole financial situation and make sure that your loan officer knows your whole situation for the 2 years if you're self-employed, and make sure you go over all of those things and the different guidelines. Very important, so that you don't waste your time and your heartstrings thinking you're going to get these funds and your money.
Excellent advice. Leroy, you had some other information?
I just wanted to reaffirm for the veterans out there listening, or those that know veterans, as we look at the home equity position, is going again back to strategy, discipline, and structure of, what are you doing financially and how is it going to work? Or if you're looking to purchase another property. Like, just do your homework. I think that that's the biggest thing. And then making sure that you're consistent. If you come across an emergency, know that it's okay to reach out to a professional just to kind of strategize and see if it makes sense. Because the flip side of this is America's sitting on so much equity position to either invest in or clean up some of the things that might have happened, whether they were crazy mistakes or crazy life situations, right? And all of those are okay, but now you're in a position where you don't have to suffer through the pain of those crazy payments that you might have on either medical bills or things like that when you have options available. So that's pretty much it.
That leaves you, Jason. So you're going to get the final word on what everyone should know when considering a HELOC or any other type of second mortgage.
Yeah, I can't add anything better, than these guys. I mean, these guys are so much smarter than me. The thing that I would end with is, if you're a veteran and you've got veteran buddies that aren't in the group, get your buddies in the group. They may not be thinking about buying, they may not think about refinancing, but they could be learning from stuff like this. They could have other buddies that do need this. We got to go back to the buddy system we have in the military. Get your buddies where they need to be, and get them in better VA.
No, that's great advice. And what I like about the show of being able to get here every week is when we're just moderating. When I say we the vetted VA experts, when we're moderating, you're behind the scenes. It's just a name, and yeah, it has a little moderator badge, but the people don't get to know you guys. They don't get to see the face. They don't get to hear the context of the discussion. It's hard to just type out and answer, and even in a quick video response to the great questions that the veterans ask every day. But if you guys, we've got 6 weeks, we probably have 3 experts every week, so 18, 20. We're going to work through every vetted VA expert is going to come on the show, share their knowledge and expertise with you and go through these topics. But these are the folks that are here every day to answer your questions, moderating in the forum. So definitely take advantage of it. Like Jason said, get your buddies in here so we can continue growing the group, getting all the information out there to help more of you become homeowners, help those of you who are homeowners use it strategically to build wealth over your lifetime. So again, all 3 of you, this was awesome. Content was great. Appreciate all of you for showing up and sharing with us. All right, have a good night, guys, and we'll see you next week.
All right, thank you.